Welcome to Daybreak Australia. I'm Haidi Stroud-Watts in Sydney, where markets have just come online.
And I'm Paul Allen. The top stories this hour. A weak lead-in for Asia with US stocks and bonds lower. Strong factory data reinforcing the view a Fed rate cut may not happen this quarter.
Well, fading Fed pivot hopes also hurting the yen, 152 to the dollar in focus as a potential intervention level.
Plus, we look at the future framework for Australian monetary policy, speaking live with RBA Assistant Governor Chris Kent.
Well, inflation and monetary policy top of mind as we get CPI numbers just crossing the Bloomberg for Korea this morning. We are seeing more or less in line with expectations when it comes to that month-on-month consumer price index coming in at just 0.1%. That is a softening from the 0.5% that we saw in February. The year-on-year number for CPI a little bit hotter, 3.1% at a faster clip than the 3% that was the consensus survey, and matching the same pace that we saw in February as well. Stripping out volatile food and energy prices year-on-year, that number coming in at 2.4%, a little bit lower than the 2.5% in February. So a little bit more progress towards that 2% target for the Bank of Korea, but still clearly has some way to go. We're seeing that smaller increase in fresh food prices, that price stabilisation policy by the government leading to that slowdown. We also saw a bit of a rise in retail gas prices as well, pulling in the other way. These readings, according to Bloomberg Economics, unlikely to change the BOK's narrative that that final stretch to 2% will be bumpier with that inflation level still fairly elevated. Private sector debt risks also continuing to build for the Korean economy poll as well. So we're watching to the shift in policy guidance in its May meeting, but expectations that will stay on hold for the Bank of Korea until the middle of the year.
Well, let's take a look at how we've opened in Australia. We're just 2 minutes into trade here. We have a staggered open, so we'll wait and see how things unfold. A lot of stocks going ex-dividend today, so it could be a bit of a bumpy ride, but at the moment we're better to the tune of 0.1%. We'll be watching Treasury wines a bit later. Of course, China lifting those trade strikes on Australian wine just before the long weekend. Miners will be in focus too. We've seen the iron ore price recovering a little bit after sinking to a 10-month low. We had some pretty decent PMI numbers out of China over the weekend also. Take a look at the bond space. Yields edging a little bit higher. We did see yields gaining across the curve in the US after that strong ISM factory data. But here in Australia, we've also been hearing from Assistant Governor Chris Kent. He's going to be joining us on set shortly. He's saying the RBA still not ruling anything in or out when it comes to the future path of rates in Australia. Let's take a look at futures for the Nikkei in the meantime, setting up for what could be a slightly down day. The yen definitely one to watch. That weakened on the back of that US data as well, and the finance ministry still making noises about possible intervention. There we have 150-163 still hovering around those 34-year lows, Heidi.
Yeah, take a look at how we're trading when it comes to US futures, given again this renewed focus on how that last stretch of the inflation fight feeds through to Fed expectations as well. S&P futures looking pretty flat at the moment, about 0.1%. If you take a look at the bond markets in the US, bond traders are pricing in less monetary policy easing by the Fed this year, and potentially even briefly set the odds of a first move in June at below 50% after that US manufacturing activity showed expansion for the first time since 2022. That has really been really top of mind when it comes to where we've seen the dot plot kind of fall since that last meeting. We're also watching oil markets as well, oil rising on the prospect of tightening crude supplies in the Americas, while an Israeli attack in Syria as well threatening to widen the Middle East conflict. And a lot of this really accumulating in the fact that we've seen that upward momentum in crude prices, all hitting those October highs as we see those export cuts from various markets. So New York crude currently trading at just under $84 a barrel. But as we continue to look at Fed cut odds, take a listen to Chair Powell.
Report that came out this morning is pretty much in line with our expectations. We're making progress. This is good, but we need to see more. The decision to begin to reduce rates is a very, very important one. The economy is strong. We see very strong growth. We had growth for last year over 3%. We don't need to be in a hurry to cut. It means we can wait and become more confident. I don't think rates will go back down to the very, very low levels they were at before the pandemic. This economy doesn't feel like it's suffering.
Let's bring in Nicholas Brooks, who's the head of economic and investment research at the Intermediate Capital Group. So, Nicholas, let me get your gauge when it comes to the data. And obviously, we're so data dependent at this point that each release kind of has the potential to reposition market expectations a bit.
Yeah, no, absolutely. I think we're highly data dependent right now, and for good reason. I think markets are really priced to perfection, very much focused on the soft landing and the Goldilocks scenario. And I think investors are all trying to gauge which way we're going to go. I think there's some concerns now, in fact, that maybe we won't even see a landing in the U.S. And obviously that would have implications for U.S. bond yields. We saw them push higher today on the stronger than expected ISM. On the flip side, we are seeing the PCE coming down. So we're seeing inflation moving in the right direction in most countries, but slowly. So, I think everyone is just trying to understand whether, we're really going to get away with a soft landing and markets can keep performing, or if we're going to see a no landing scenario and perhaps see inflation remain very sticky and therefore a reassessment of rate cuts, which I think would be quite negative for risk assets.
The consensus trade still seems to be US exceptionalism, right? Are you seeing better opportunities outside of the US? You say that there's an underestimation of performance from Asia and Europe, and I'm assuming that's even with the underperformance structurally of China.
Absolutely. I think, the U.S. equity markets had, an incredible run, particularly tech and, the so-called Magnificent Seven. But there have been a lot of laggards. So small cap stocks have lagged. Europe has lagged to some degree. And certainly Asia has lagged as well. So my own view would be, from an asset allocation point of view, is I would be looking a lot more at Europe. I would also be looking at certain markets in Asia as well, mainly because I think that those 7 stocks in particular, but tech in the U.S. has really had a run, and they're looking very expensive on any measure that any traditional measure that one might use. Whereas if you look at the smaller mid caps, they actually look relatively attractive relative to history, or at least in line with history in the U.S. and in Europe. The discounts, if you look at PE, price to book, relative to the U.S. are, in some cases at historic lows. So I think that's quite attractive in the environment we're in. And just to add in one, I think, interesting change has been the possibility that we may be seeing a sustained pickup in the industrial cycle. And I think anyone who's covered Asian markets for a while or Europe for a while recognizes that Asia and Europe do tend to outperform when we see a pickup in the industrial cycle, given the natures of their economies. So, this may be the time to make that kind of switch.
Nicholas, just cycling back to the Fed, the environment you're describing here doesn't sound at all like an economy that's in the need of easier policy, in the need of rate cuts. Do you think there's some more repricing needs to be done in terms of market expectations here?
I agree completely. And actually, as the clip you showed earlier of, the Fed chairman speaking, the U.S. economy, last quarter, 3.4. The fourth quarter, 3.4%. First quarter looking like it's running around 2%. So the U.S. economy does not seem to be slowing a lot. I mean, obviously, we can always find some indicators that point to slowdown, and I suspect the economy will moderate. But the U.S. economy is going along very strongly. And what worries me most, frankly, is the U.S. inflation, the services inflation, is not coming down as quickly as I think the Fed would like to see. So if you look at the core PCE ex shelter, it did improve a bit in Feb relative to January. But if you look on a year-on-year basis, it's still pretty elevated. And that really, to me, is the critical indicator for what underlying domestic inflation pressure is in the U.S. So all of that would point to me that there's absolutely no rush for the Fed to start cutting rates.
Yeah, that battle not won yet. Is there another risk to consider here as well? We heard from Citadel's Ken Griffin a little bit earlier. He says he's really worried about U.S. national debt. Is that in your risk column, and are there any other risks you're looking at as well?
Yes, most definitely. And I think this all plays into this, what I would say, in my view, the biggest risk, it's not our base case scenario, but in my view, the biggest risk that markets face this year and probably into 2025 is the backup in US government bond yields, which has a ripple effect through other markets. And on top of the pickup in the US ISM and the industrial PMIs, and the stickier than I think the Fed would like to see underlying inflation. On top of that, of course, is the US government is issuing huge amounts of debt and will continue to do this going forward. We're running in the US, a deficit of 6 to 7% of GDP when the economy is doing well. So far, we haven't had a kind of UK Liz Truss kind of moment in the US, and I wouldn't say that I think that's going to happen anytime soon. But at some point, the bond vigilantes come back out again, and that is a risk, and I think needs to be watched quite carefully.
You mentioned earlier about how some of these AI valuations are looking a little bit stretched. Do you see opportunities in this space in Asia that may be going a little bit unappreciated at the moment?
Yeah, I mean, I think if you look generally at valuations across most of Asia, they look attractive, certainly relative to the US. And within that, of course, there are a number of tech segments that look very attractive. I would also, jump in with, looking at the most recent PMI out of China, as you mentioned earlier, and indications, not just indications, actually, the authorities in China have been easing, not as quickly as they might have in the old days, but we are seeing monetary easing coming through in China, and stocks in China are pretty beaten down. So I think there are probably a lot of interesting investments in the Chinese stock market, and tech would certainly stand out.
All right, Nicholas Brooks, Head of Economic and Investment Research at ICG. We'll have to leave it there. Thanks for joining us, though. Still to come, we're going to head, we're going to be speaking with RBA Assistant Governor Christopher Kent on Australia's future framework for monetary policy. He joins us live right here next. This is Bloomberg.
Well, Bloomberg has just hosted its Australia briefing event here in Sydney, where the central bank's assistant governor spoke on the future of monetary policy implementation. The RBA will switch to a new system as passive quantitative tightening leads to a decline in reserves in the banking system. Joining us now is Christopher Kent, who's the assistant governor for financial markets at the Reserve Bank of Australia. And Assistant Governor, really great to have you with us, and it's a pleasure to have you here at Bloomberg. Just upstairs, you were talking about this change in the monetary policy implementation system as being about the piping, not about the temperature of the water that's rushing through the pipes. Can you elaborate a little bit more on that?
Yeah, so what we've announced today is a new system for implementing monetary policy, what we'll be transitioning to in the future. But I wanted to emphasise that really is about the plumbing, the nuts and bolts of moving money around, about us achieving our cash rate close to the cash rate target, but it's not what that target is. What that target is monetary policy. This isn't about monetary policy, it's just how we achieve the target at any given time.
But it's also about responding to perhaps some of the imbalances within the system structurally coming from the last few years.
Well, it's about responding to the running down of the very large level of reserves. We call that excess reserves that are in the system, because we and other central banks pursued unconventional monetary policy. So they put a lot of money in the bank's accounts. Those are gradually unwinding as our bonds mature, as the TFF gets repaid. So it's about looking to the future and thinking about how, what we need to do to sort of what system we need to transition to.
When it comes to the moderation of that balance sheet, obviously a lot of it will depend on underlying demand, but do you have sort of an idea of scale, of timing, of how that framework will play out?
No, we don't, and indeed that's partly why we picked the system we've picked. So what we've chosen is what we call a full allotment allocation system at our OMOs. That means the banks come to us and for a fixed price they can borrow reserves, pledge collateral for 28 days at the moment, and they can take what they want as long as they have sufficient collateral. So what that means is the supply of reserves is going to depend on the bank's demand. The banks have their own estimates. We could come up with some rough ones, but until we get there, we won't know. But it should transition fairly seamlessly from one of excess to ample, and we'll know we're there when banks start showing up in larger numbers and larger quantities at our operations on a weekly basis.
I think until we get there, we won't know. Probably, is a good phrase to describe a lot of aspects of where we're at the moment in terms of monetary policy. Upstairs, you were asked, a little bit cheekily to give one word to describe monetary policy settings and trajectory. I'm going to give you a few more words if you want. Can you elaborate?
Yeah, I think the starting point is just to say that the board's made it clear it thinks the interest rate path that will best bring inflation down in a timely manner is uncertain. And so they've not wanted to rule anything in or out with regards to interest rate changes. We're in a better place than we had been. Inflation's come down a long way. It does look to be moderating, but the path, according to our forecasts, is a gradual moderation from here. Labour market pressures, they're easing. They're still tight, but they're easing, and that's because growth's slowing, and so that brings demand into a better balance with supply. So all those things are in place. Our central forecasts are sort of predicated on sort of further good things happening, including productivity growth, but there's a lot of uncertainties around that. And I think the key point is those are reasonably well balanced as best we can tell, and because of that, the path's uncertain. The next rate change, don't know if it's higher, don't know if it's going to be a lower interest rate.
When you talk about the inability to rule out shocks, right? How much of those risks do you worry about that might be external, that might be geopolitical, that might be election-driven, the policies of other countries, and how much of it are sort of domestic, maybe structural, macroeconomic aspects that perhaps we haven't seen in the data sets yet?
I think it could be both. We just don't know. But I mean, as a small open economy, we're always subject to developments offshore. We've talked quite at length about what's happening in China. China's a major export market for us, and there are concerns there about their property sector and the problems that they're trying to deal with there. So that can have an impact on things like the demand for our key commodities like iron ore, and that can move our economy around. But equally, domestically, things can be moved by what people here in the Australian economy are doing, particularly households at the moment. How are they going to behave in the future? That will sort of be a key point for where the economy goes.
And households, actually, I wanted to get your views on, in particular, the savings data, which I know you look at quite closely. There's been a lot of concerns about global debt, right? Government debt and household and private debt. And in Australia, we know that the latter dwarfs government debt levels. What are you seeing in the data at the moment when it comes to household saving and spending, and are you concerned?
No, I'm not. I think what you can see in a number of different places is household savings may be holding up a bit more than people would have thought. And I say that because we know household consumption's very weak. And households also built up not all households, but many households built up a big buffer during the pandemic. And they're running that down, but running it down quite slowly. And households with mortgages are still paying extra. Overall, not all mortgage holders, but overall, households with mortgages are paying extra into their accounts, into their offset and redraw accounts. And that's holding up around the sort of average levels. Even picked up in the last sort of 6 months. I think that's a sign that monetary policy is working, because one of the things that monetary policy does is when interest rates are high, provides an incentive to save. So maybe that's telling you monetary policy is working.
The same sort of rhetoric you're hearing from a lot of central bankers trying to navigate this last trickier leg of this policy cycle. How difficult is it to be a central banker in this environment at this point in time, after everything that's happened in the last few years?
Look, I think they always sort of want to look with fresh eyes at all of the data that comes in. But central bankers also need to take a slightly longer term perspective and be thinking about the trajectory and weighing up all the sort of bits of information that markets get very excited about, but it only adds incrementally to what we really know. And I think all central bankers at the moment are just looking, are we really on this path where inflation will come down? labour markets, which have been very tight, will ease, but not too much, so that unemployment rate won't rise too much, and we can hold on to all those employment gains we saw during the pandemic, particularly here. So, I mean, it's always a challenge, but that's the job. That's what they're doing.
And financial markets have still remained very sanguine about the potential risks in what this next part of the journey looks like, right? Are you comfortable with that optimism? Do you think, for Australia at least, we'll stick another soft landing and, you know, keep being the lucky country because of better monetary policy?
Well, that's what the board's very much focused on, trying to bring inflation down, but in a gradual way, so as to maintain as many of those gains in the labour market as possible. One never knows. I mean, private markets, equity markets, private bond markets, they're fairly richly priced at the moment, and we've made references to that in a financial stability review. So the central bankers would be watching for those markets, and there's always could be a period of adjustment. As I said upstairs in response to a question, financial conditions here in Australia, those sorts of things are important, what's happening in private markets, but a lot of what matters is just what's happening to the cash rate, what's happening to BBSW rates, what's happening to the short end of the yield curve. That's the nature of our markets.
Such a pleasure to have you here. We appreciate your time. And that was Christopher Kent, who's the Assistant Governor at the Reserve Bank of Australia. And you can always catch us live and catch up on those past interviews on our interactive TV function. That's at TV Go. You can dive into any of the securities or the Bloomberg functions that we talk about and join in on the conversation as well. You can send us messages during our shows. This is for Bloomberg subscribers only. It's at TV Go. This is Bloomberg.
All right, let's take a look at how we're tracking on the ASX after the first 26 minutes of trade. We've got Treasury Wines, one of the top performing stocks in Australia right now, better by more than 3%. Treasury saying it welcomes the removal on tariffs on Australian wine. So that dropped just after the close of last week's shortened trading week when China announced that it was removing all tariffs and other barriers against Australian wine. So this is the first opportunity Australian winemakers have had to react to that, and we're seeing taking it pretty well. Treasury up by 3%. Other strong performers today is the mining sector. All of Australia's major mining companies in the green at the moment. BHP the best performing, better by 1.7%. This as iron ore prices recover. They did touch a 10-month low. Iron ore prices, or spot iron ore, now back above $100 per tonne on what turned out to be some pretty decent numbers out of China on the weekend. PMIs coming in a bit better than expected. Taishan PMI is also pretty strong. The property sector in China, though, still pretty weak, but iron ore miners liking that news out of China. Okay, we've got the price there, as you see, better by 1.35% for spot iron ore out of Singapore. Plenty more to come on Daybreak Australia. This is Bloomberg. Let's take a look at how the yen's doing. It's firmed a little bit after approaching 152 per dollar. That's a key level for potential intervention by Japanese authorities. The currency did slip on strong US factory data that reinforced bets the Fed's going to take its time when it comes to lowering rates. For more, let's bring in our G10 FX reporter, Anya Andrianova. So, Anya, what's next for the yen? Is the jawboning going to be enough to put a floor under things?
The issue that each next verbal intervention is bringing less and less support for the yen. So at some point, they will have to do something. But I'm afraid it's a little bit more weakening for the yen. The base case that the Bank of Japan is not going to hike aggressively this year, and all eyes turn to the Federal Reserve. And just on Monday in the US, we had data that was surprising to all economists, so hotter data than expected, meaning that markets started repricing how many cuts they see by the Federal Reserve. With that together, it weighed on the yen again.
Anya, what needs to happen now for Japanese authorities to step in and actually conduct an intervention?
Yes, that is a million-dollar question. So basically, right now, if the yen continues slowly moving towards, say, 152, which is a line in the sand that many observers and traders are watching, because last time they intervened close to that level, and when yen got to that level last week, everyone got very nervous. So now, if they get close to that level and break through, it's a lot of resistance there. And of course, it's not set in stone. It's just a level that traders are watching. And of course, Bank of Japan and Minister of Finance in Japan is watching. So once it gets through, there can be there can be some time of nervous reaction. And it then can move quickly. And if that happens, if the move is quick, then they can step in. They are very aware. They don't want to make an impression that they're targeting a certain level. That's what they are saying. But if the move is fast, which can happen as soon as tomorrow on Tuesday in the US, when we have new data about economy in the US, if it's getting hotter or not, how many cuts. So then we have another report on inflation next week. So for the several days going ahead, it will be a nail biter.
Intervention tends to be pretty futile, right? At least if you're taking a look at sort of long-term impact.
Yes, that is another big thing for the Bank of Japan, for their reserves, for the Minister of Finance to decide to intervene. They need to be sure that this would bring a certain result, because it is, as you said, futile, fight the market. And maybe they will decide to wait for this nervous reaction when the yen would get weaker for some time, and then support it with intervention. But just going straight front to the market, that would be not a smart move. And market likes to prod regulators and central bankers, so they will try to see how far they can go. So this is an art how to make intervention last, even though Japan has resources to do intervention, they would be very cautious in actually stepping in.
Our G10 FX reporter Anya Andrianova there, an art form when it comes to FX intervention. So we're on the watch out for that, particularly as we do tend to get jawboning from financial markets regulators and the finance ministry at some point this morning. Take a look at how we're setting up when it comes to the rest of those markets, plus Australian stocks online now for just about half an hour. We're seeing a little bit upside, about a tenth of 1% there, as we had really many parts of the markets from bonds to stocks really coming under pressure after that US data that came in stronger than expected, and that big climb that we saw in 10-year yields in particular. Taking a look at New Zealand, we're seeing that really on the back foot by about 0.5%. Japan Nikkei futures are up by about a tenth of 1%. But as we've been discussing, heavy pressure when it comes to the downside of the yen, but that yen will provide for some of those Japan equities, particularly those export-oriented and FX-sensitive names, to trade quite well today. S&P futures are looking a little bit softer at this point, and marking Paul, clearly dollar yen is going to be key focus today. Still under that 152 level that we see as the threshold potentially for a real intervention.
Yeah, well, let's change gears a bit, talk about the global IPO market. Now, that saw a shift in geographical composition in the first quarter of the year. Volumes down 7% on year, and the latest survey by EY also records a sharp decline in mainland China and Hong Kong. Joining us now to talk about this, we've got George Chan, global IPO leader at EY. George, thanks so much for joining us. Let's talk about some of the trends you found in your report. So you've got global IPO volumes falling, but proceeds are rising. Can you explain this trend for us?
Well, basically, if we look at the IPO trends for the first quarter in 2024, we need to break it down into different regions. The trend is what it is because Europe, EMEA, and the US, they're doing pretty good. But overall, the statistic has been dragged down by the poor performance in China and mediocre performance in Hong Kong as well. So this is why we are seeing IPO numbers increase, and then the IPO proceed also decrease because more smaller deals there are across the globe.
So you're anticipating, Bloomberg's been doing some reporting that supported a lot of what you've found, particularly in terms of a pickup in South Korea, India. You mentioned Japan there as well. What's the environment for IPOs in Japan in particular right now?
I think the Japan market is quite unique because the economy is growing okay, but there are lots of government policies stimulating the dividend policy or the redemption policy, which lead to the very booming IPO or the stock markets. When the BOJ now ends the negative interest rate era, but as we can all agree, the strength is quite moderate at this point of time. So I would expect a lot of the IPO candidates, they will adopt and wait and see approach to see whether this would have any effect on their IPO plans. So in short, I would expect the Japan IPO market to be still active for quite some time, at least through to the third quarter of this year.
In terms of sectors and themes, it's unsurprising that tech is showing so much leadership, right? Is this all down to chips and AI-related names?
I do think AI would be another very important category of companies, because from our report, we found that a lot of AI, they are pretty much in the PE and VC stage. And also, we have seen quite a bit of PE VC backed company going to the IPO market, which is an indication of PE/VC. They do find the valuation is right at this point of time. So I do expect, apart from the tech companies, the AI-related company would be another major source of IPO candidate throughout this year.
I wanted to ask about Hong Kong. Obviously, this has been such a struggle for the market, and losing Haidi, whilst that withdrawal was perhaps not a surprise for those that have been watching developments. How much of a sentiment hit is that for the pipeline?
From my perspective, I do have a cautious optimistic for the IPO market activities in Hong Kong, because we are expecting a interest rate cut, although there are some uncertainties, but the market, I think they have already factored in. And we have also seen the application increasing in the first quarter when compared to last year. And also for those listed company in the first quarter, the aftermarket performance of those companies, they have been pretty impressive, even up to today. So I think the market sentiment is there. And we have adequate candidates, just like the manufacturing company, the consumer industry company coming from China, as the Chinese market has been placing on a very tough scrutiny on IPO candidates. So these candidates will probably land in the Hong Kong market. It is now a matter of whether the IPO candidate and investor can agree on the valuations, so this market sentiment can continue into the second half of the year.
Just want to circle back to those remarks you were making about AI-related IPOs, obviously the hot topic of the moment. I'm just wondering if you found any evidence of 90s .com style exuberance in this space.
At this point of time, we need to still adopt a wait-and-see approach, because most of the AI companies, they are still in the early stage. But from our data, we see a lot of them. We have also talked to a lot of them, and from their representative, it is actually they really want to tap on the IPO market to expand their operations. So we would expect to see quite a bit of AI company going in debut in the IPO market across the world.
All right, George Chan, we'll have to leave it there, but thanks so much for joining us. George Chan is Global IPO Leader at EY. Well, here are some developments in the corporate space that we're tracking. Nippon Steel has made a formal commitment on spending and jobs to the United Steelworkers Union. The agreement includes an extra $1.4 billion in capital spending, as well as a promise of no layoffs before 2026. Nippon Steel's new president has pledged to press ahead with the takeover, and that's despite opposition led by President Biden, who says that U.S. Steel should be American-owned. Bloomberg has learned Tesla boosted headcount by 86% last year in Austin, Texas. The firm now has more than 22,700 employees in the region, where Tesla churns out its Model Ys and Cybertrucks. And this officially makes Elon Musk Austin's largest private employer. Texas is home to multiple Musk firms, including a Tesla Gigafactory and, of course, the launch site for SpaceX. Citigroup is said to have implemented a fresh round of job cuts in its U.S. investment bank last week. Sources say technology, media and telecom were among the coverage areas hit the hardest, with senior bankers and junior roles affected. The cuts come as Citigroup says it has concluded the major actions around its reorganization plan. McKinsey's offering 9 months' pay and career coaching services to some UK staff who would like to leave. The move comes after the firm earlier warned some US consultants that they were running out of time to win promotions. McKinsey and its peers have trimmed headcount and slowed the pace of hiring over the past year as demand from clients declines. And you can get a roundup of the stories that you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to Daybreak Go. This is also available on mobile in the Bloomberg Anywhere app. And you can customize your settings so you're only getting news on the industries and the assets that you care about. This is Bloomberg.
We do have some breaking news when it comes to Rapidus and what Japan's Ministry of Economy, Trade and Industry are doing to support the company. This is a Japanese company offering to aim for mass production of its 2-nanometer chips. According to TV Tokyo, Japan's Ministry of Economy and Trade and Industry will be offering as much as 590 billion yen in additional support. That would bring the total amount of financial support from the government to nearly 1 trillion yen. More than 55 billion yen would be spent on research and development of packaging technology. The rest would be allocated to manufacturing equipment and construction costs. We have seen reporting that Rapidus will start doing business in the US this year, with the Japanese semiconductor maker set to expand across that market later on this year. They've also been working when it comes to being part of a $10 billion of additional subsidies for a couple of key semiconductor projects, and one of them has been that one for Rapidus. We'll get more details on that story as it develops. But shifting gears, the oil and gas sector appears to be shifting away from renewables in its decarbonisation efforts. New data from Bloomberg NEF shows the industry turned to so-called clean molecule technology, such as carbon capture. BNF downstream oil analyst Lucy Hong joins us now from Shanghai with more. And Lucy, talk us through these trends when it comes to the energy transition. And ultimately, is there something to be concerned about?
I wouldn't say it's something to be worried about, but I'd rather say that the decarbonization effort for the industry is becoming more diversified. Previously, renewable power was the dominating technology in energy transition investment for the sector, with solar and wind alone accounting for 60% of all the investment from 2015 to 2021. Since then, this dominance has diminished. We are seeing investment in renewable fuels, carbon capture and storage, and advanced materials hitting all new highs in the past 2 years. Actually, last year was the first year when clean molecules take the lead in investment. So in general, we are seeing oil and gas companies' energy transition investment switching away from clean electrons to technologies that create greater synergies with their current fossil fuel operations, such as CCS, renewable fuel production, and plastic recycling, etc.
So let's talk about some names. Which oil and gas firms are leading these charges in the low carbon investment trend?
There are two groups of companies I'd like to highlight here. First is the U.S. oil companies, such as ExxonMobil, Chevron, Occidental, and some U.S. refiners. They have all prioritized clean molecules technologies in their energy transition investment, such as CCS and renewable fuels, with very little interest in renewable power whatsoever. The other group of companies, the European oil majors, such as BP and Shell. Previously, they have led the energy transition investment hydrocarbon trained within the sector with their very big bets on renewable power. However, we are seeing some of them slowing down their previously very aggressive expansion in renewable power and focusing more on other low carbon segments such as biofuels, EV charging, or green hydrogen production.
What are the main drivers behind these companies' change of focus?
Obviously, each and every company would have their own consideration when it comes to energy transition strategy, but I think the overarching themes here are policy push and profitability. For the U.S. oil companies, they have prioritized CCS and renewable fuel production in their energy transition investment because the country has very encouraging policies for such investment. They have tax credit or funding opportunities, etc. For the European oil companies that have slowed down their previous expansion in renewable power, I believe the lower returns of renewable energy projects are the possible drivers behind such change. Both BP and Shell have lowered their return targets for renewable power portfolio to 6 to 8%. This is actually much lower than their return target for other low-carbon segments. For example, BP is targeting over 15% return for its investment in bioenergy, and Shell is targeting an IRR hurdle rate of 12% for its investment in low-carbon fuels and EV charging portfolio.
All right, BNF downstream oil analyst Lu Shihong there in Shanghai. Let's take a look at some of the geopolitical developments that we're tracking around the world. Iran and Syria say an Israeli airstrike on Tehran's embassy compound in Damascus has killed several people, including 2 military generals. Iran's foreign minister says Israel should be held accountable for the attack, while the country's envoy to Syria promised a decisive response. Israel wouldn't confirm it carried out the strike, but says it will take any steps that serves its war on Hamas. The US and Israel have agreed to an in-person meeting to discuss their dispute over an expected Israeli invasion of the southern Gaza city of Rafah. The statement says Israel agreed to take US concerns into account. That appears to mark a concession by Israeli Prime Minister Benjamin Netanyahu, who earlier scrapped a delegation's planned visit to Washington. Indonesian President-elect Prabowo Subianto has met Chinese leader Xi Jinping in Beijing. State media says Xi told him China is willing to boost strategic cooperation with Indonesia and help with poverty relief. Prabowo now heads to US ally Japan for a meeting with Prime Minister Fumio Kishida, indicating he'll continue Indonesia's centrist strategy in navigating the US-China rivalry. Well, be sure to tune into Bloomberg Radio to hear more from the day's big newsmakers and get in-depth analysis from the Daybreak team, broadcasting live there in our studio in Hong Kong. You can listen via the app, Radio Plus, or BloombergRadio.com. Plenty more to come. Stay with us.
Take a look at how currencies are trading, and of course the biggest focus is really where we're going to see the yen travel in the day. Japan intervention would potentially come at that 152 level. We're just shy of that level at the moment. It would, strategists say, target that 5 yen rally, and we could see authorities employing several trillion yen, according to Nomura, when it comes to targeting that 5 yen rally against the dollar. If they do in fact decide to intervene in FX markets shortly, we could actually see some more jawboning as well, as we see really the dollar impact, the dollar nearing its year-to-date high after those surprising ISM readings. The dollar really tracking those treasury yields higher, looking close to the strongest levels that we've seen since about mid-February. That March ISM report showing manufacturing activity in the US unexpectedly seeing a significant expansion and price pressures remaining high as well. We're seeing the Bloomberg dollar index in that session up by about 0.4%, reversing that earlier loss. 1251.21 is where we're at when it comes to the year-to-date high, and it is up against just about all of its G10 peers as well. Paul, let's take a look at some of the stocks that we're watching in the session.
Yeah, there'll be a few to keep an eye on when we get going at the open at the top of the hour in South Korea and Japan. So let's take a look at some of those stocks to watch when we do get trade underway. Nippon Steel is one of those that we're keeping an eye on. looking to build support for that US steel takeover. It does say it's made a formal commitment to the United Steelworkers Union for an additional $1.4 billion in capital spending, making a promise there as well that there's not going to be any layoffs until 2026. Rakuten, that was one we were watching yesterday as well. It's returning to the high-yield bond market with an offering of more than $1 billion. This is after a strong rally in debt that it sold earlier this year. And Asian Tesla suppliers, they're going to be back in focus as well. Analysts are rapidly lowering projections for this week's deliveries report from Tesla. Some are seeing a first decline since the early days of the pandemic. As always, chip makers going to be in focus. This is after Japan, as we were just reporting, approving up to $3.9 billion in subsidies to chip venture Rapidus, committing more money to its ambition to catch up in semiconductor manufacturing.
Yeah, chip makers AI will be in focus as we get into the Tokyo session, which is shaping up with a bit of positivity, particularly as we get that weakness in the yen that will be supporting a lot of those trade and export related names as well. We did see Japanese equities falling earlier in the week, though. Investors taking a bit of profit, unsurprisingly, on that first day of the new fiscal year. The Nikkei 225, though, having its strongest quarter in almost 15 years. We saw some weakness across automakers, so watching to see if that continues to after we saw a BOJ survey showing sentiment for large makers of cars actually seeing some declines there as well. So a lot of those top performers are seeing a bit of profit taking in the previous session. We'll see if that reverses as we get into the open. Australian stocks at this point, an hour into trading or so, pretty steady. Miners are rising. Health shares, though, are among some of those that are lagging. A pretty muted start, really, as we saw Wall Street edging lower on the back of really investors trying to make what they will of the very solid US factory data and expectations that perhaps the Fed will really not be in a rush to cut rates. The market opens in Seoul and Tokyo are next. This is Bloomberg.